close on a home loan, you'll pay an initial round of interest in with your closing costs. In this video, I'm going to talk about this interest. It's a lot more interesting than you may think. For one thing, it's one of the most variable elements of your closing costs, and it determines when your first mortgage payment is going to come due. And once you understand how this interest works, you can use this information to manage how much money you need to pay at closing and maybe even shorten your loan term and save on interest just a little bit. And make sure you stick around to the end of the video. After I talk through how this interest works, I'll teach you how you can use it as a litmus test for your lender. And if you find this video useful, please remember to like and subscribe. So let's break it all down. Closing costs fall into two categories. One-time expenses, which are true closing costs, the stuff you pay because you're buying and financing a house, and you won't pay it again until you finance a house again. And then prepaids, which are an initial installment of the recurring expenses associated with your loan and owning your home. Now, the interest that you pay at closing is part of your prepaids. And if you're curious to take a significantly deeper dive on the rest of closing costs and prepaids, don't miss the video that I've linked up above. Now, in general, interest is due in arrears. And this makes sense if you think about it. As time passes, interest accrues and then it comes due. So your bank, for example, credits interest to your savings account on the last day of the month, right? This is also true for the interest that you pay on a mortgage as well. This is the opposite of rent. When you pay rent, you're paying rent for the month ahead. When you pay a mortgage, you're paying last month's interest, except for the interest that you pay at closing. It's the exception to the rule. Remember, I said this interest is part of your prepaid, so you can take that prepaids label really, really literally. You are just this once prepaying for interest before it's actually accrued. And you can calculate the interim interest in three really simple steps. First, multiply your loan amount by your interest rate. Then divide that number by 365. And finally, multiply the result by the number of days from your closing date to the end of the month in which you're closing. That first step, multiplying the loan amount times the interest rate, tells us the annual interest cost for your loan. And then we divide that by 365 to get a per day cost. And then we multiply that by the number of days in the month to figure out how much interest you'll owe to cover the time between your closing date and the end of the month. So let's say you're borrowing $400,000 at a 6.5% interest rate. $400,000 times 0.065 equals $26,000. $26,000 divided by 365 gives us a $71.23 per day interest costs. So let's say you buy a house on the 1st of July. You'd owe for a full month 31 days of interest at closing, which would be $2,208. $71.23 times 31. But if you closed one day earlier on June 30th, the last day of the month, you'd only owe 1 day of interest, 71 bucks. So that's over a $2,100 difference in the amount that you'd need to pay at closing. Interim interest really is one of the most variable parts of what you'll pay at closing. Now, before you get all excited about closing late in the month to save money, we need to talk about another important piece of the puzzle, which is how interim interest ties into or really drives the due date for your first mortgage payment. So let's say you close right in the middle of the month on June 15th. From June 15th to the end of the month, there are 16 days at $71.23 a day. That'd work out to $1,140 of interest due at closing. Now, let's think through when your first mortgage payment should come due. So you close June 15th. When July 1st rolls around, do you have to pay a mortgage payment? You don't. Remember, mortgage payments always pay the prior month's interest. You paid all the interest from your closing date until the end of the month at closing. So June's covered. And on July 1st, there's no interest to pay. The only thing that happens on July 1st is that the interest starts accruing for the month of July. That July interest is what you'll be paying when you write your first mortgage check on August 1st. So your first mortgage payment comes due the first of the month after you close. Close in June, anytime in June, skip July, and your first payment is due August 1st. Close in July, again, any day in July, and you'll skip August, and your first payment will be due September 1st. Got it? Cool. So close early in the month, say on June 1st, and you'll pay 30 days of interest at closing, but then you'll be a full 60 days away from writing your first mortgage check all the way out on August 1st. Close on June 30th, and you'll pay only a day of interest at closing. Your first mortgage payment is still August 1st, but that's only a month and a day away. You can think of your closing date and the amount of interest that you pay at closing in connection with that as more of a when you pay than a what you pay kind of question. And as a practical matter, this 30 to 60 day delay between closing and picking up with writing checks on your mortgage does a couple of helpful things. One for your lender and one for you. For your lender, it buys some time to get your mortgage set up in their system. The collection of mortgage payments is called servicing, and it can take 30 days or more for a lender to set up servicing on a mortgage. You'll most likely actually receive temporary coupons with all the documents that you sign at closing. Keep an eye out for these because you may wind up using these to pay your first payment or two manually while your lender gets you set up in their system or maybe transfers your loan to a different company for servicing. Keep an eye on your mailbox too after closing. Watch snail mail and email for notices about servicing so you know who and where to pay once servicing gets set up. Now for you, the interest that you pay at closing has the effect of kicking the can on your first mortgage payment. And this is extra noticeable when you move from a rental into a new home that you own. In our example, buying a home in June, you'll probably pay your last rent check on June 1st, and then you're not gonna have a mortgage payment due until August 1st, which is nice, right? And maybe you paid last month's rent when you moved in. If you did, if your landlord collected last month's rent and first month's rent or last month's rent and a deposit when you moved in, then the first of the month may come and go twice with no housing payment due between when you close on your home loan and when you have to start making mortgage payments. And that vacation between making payments sure feels nice as you cover all of those costs for moving and settling into your new home. And if you're refinancing, replacing one loan with another, you get the same effect. It'll feel like you're skipping making a mortgage payment, but there isn't a free lunch here. At closing, you'll pay interim interest on your new loan from the day you close till the end of the month, just like we just talked about. But we can't forget about your old loan. You'll owe interest on it too, calculated in just the same way interim interest is calculated. If you close on a refinance on the 15th of June, you'll pay 16 days of interest at closing. That's on the new loan. But what about the old loan? Your June 1st payment, the last check you wrote, covered your May interest from May 1st to May 31st. But if you close on June 15th, the interest clock keeps running for 2 more weeks after that last payment. So in addition to paying off your remaining loan balance, the principal on your loan, you'll owe your old lender interest from June 1st until your closing date. And your lender is going to use exactly the same formula that we just talked through to figure out this cost. They'll multiply your loan balance by the interest rate on your old loan, divide by 365, and then add an interest charge by the day from the first of the month in which you close until the 15th. And you'll see this math on what's called a payoff statement. You'll see that at closing. It will also probably include a few small annoying ticky-tacky fees. They do charge you a couple bucks on the way out the door. So I promise to tell you how you can use interim interest as a litmus test for your lender, and that's coming. But before I get to that, I want to muddy the waters with a fun exception to everything I just explained and stray a tiny bit into the weeds and talk about a way you can shave some interest and a little time off of your loan. Now, if your closing date falls early in the month, and that's the key to this muddying of the waters, your lender may allow you to opt out of the usual interest calculation and elect to receive an interest credit. So what's this credit all about? Let's say your closing is scheduled for June 3rd. Under the traditional rules for interim interest, you'd pay 27 days of interest at closing on a $400,000 loan at 6.5%. Remember, our daily interest cost is $71.23, so 27 days of interest would be $1,923. And as we already discussed, you'd have no payment due on July 1st and pick up making payments on your new loan August 1st. If instead you ask for an interest credit, here's what happens. Your lender shifts your first payment date forward to July 1st. And when you write that first mortgage check, it'll include all the interest for the month of June, all of the month of June, June 1st to June 30th. And wait a minute, you didn't close on your loan until June 3rd. So you're going to be paying for 2 extra days of interest for the 1st and 2nd of June, 2 days earlier than you actually borrowed the money. In theory, your lender could discount your first mortgage payment for these extra days of interest, but that type of nuanced accounting on a mortgage would be a hassle. And remember, your lender probably doesn't even have your loan servicing set up yet. So instead, they're going to square up with you in advance by paying you a credit of interest at closing for those 2 days of interest you're going to pay as a part of your first mortgage payment, but don't actually owe. So in our example, this means that instead of paying $1,923 of interest at closing, you'll receive a credit of $142, reducing the amount you need to bring in at closing by $2,065. And if you're pinching pennies trying to come up with the money that you need to bring in at closing, this could be a welcome breather. But of course, you have to forego that skipped house payment. So if you're moving from a rental and you paid your last month of rent on June 1st, you'll pick up paying mortgage payments on July 1st. So you won't have to pay twice, but you won't get that skip payment. Now you can only ask for an interest credit if you're closing early in the month. Every lender has a cutoff, which can even vary a little bit by the type of the loan. The 5th or 6th or 7th of the month is a pretty typical time frame. If you buy after that point in the month, you'll have to revert to the usual method of paying interim interest. But figure that date out with your lender and negotiate with your seller to close during that eligible window of the month, and you can reduce the amount you have to pay at closing to the absolute minimum. Now, oftentimes when I talk to clients about things that we can do to reduce what they have to pay at closing, I have to follow up with a but and explain how whatever it is that we're doing is going to cost more in some way in the longer term. And this is just a natural trade-off that almost always happens. If you're going to pay less today, you're going to wind up paying more in some way over time in the future. But this is an exception. When you close with an interest credit, you'll wind up paying less interest in the long run. And to explain why, first we have to talk about why a 30-year mortgage or a 15-year or a 20-year loan isn't actually a 30-year or 15-year or 20-year loan. The norm is to pay interim interest at closing and then start paying mortgage payments the first of the month after closing. So close on June 15th, pay 16 days of interest at closing, pay nothing July 1st, and then start making payments on August 1st. Every regular monthly payment that you make starting August 1st includes principal and interest according to what's called an amortization schedule. And amortization is just the process of paying your loan down over time. The word actually comes from the Latin root for death. L'amour in French means death. Kind of makes a fun visual, honestly, picturing yourself killing your loan off over time. That's literally the root to the word. But what about the interim interest that you pay at closing? So it's an interest-only payment, including no interest, or no principal rather. Your amortization hasn't started yet, and it's kind of an additional installment of interest beyond the 30 years of regular payment. So a 30-year loan that closes in the middle of the month, middle of June in our example, is really 30 years and 2 weeks long. 30 years of regular payments plus an extra 2 weeks of interest that you pay at closing, unless you close with an interest payment. If you close with an interest credit, you'll pay no interest at closing, skipping what could be up to an extra 30 days of interest on your loan. And then you'll dive right into making principal and interest payments less than a month after closing. You'll be making full installments from the very first time you pay interest on your loan. Now, in the ocean of interest that you're going to pay on your loan, this extra 2 weeks is kind of a drop in the sea, and hardly anybody actually keeps their loan for the full term, paying minimum monthly payments all the way through. So, this is kind of fun to talk about, but don't overthink things. Just pick the option that works best for you. If you can finagle your closing date into the first part of the month, and you're looking to have the very, 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 very least amount of money due at closing, ask your lender about an interest credit. If you're closing any time in the month and kicking the can out of ways on that first mortgage payment fits your cash flow better, then let your lender set things up the usual way with interim interest due at closing. Now, I promised I'd share a little insider tip as to how interim interest can be a litmus test you can use to vet a lender. And it's a subtle but really excellent way to gain insight into how any lender you're talking with approaches one of the most important aspects of our job as lenders, which is providing you with an accurate estimate of your costs and the amount you can expect to owe at closing. The number one thing you should do before you start a house hunt is choose a lender and get pre-approved. Getting pre-approved truly is the first step in shopping for a home. As you discuss loan options, your lender should provide a loan summary, including a detailed estimate of loan costs. And if you don't have a loan summary, request one. And honestly, if your lender didn't volunteer one until you asked, that's a little bit of a red flag. Talking through closing costs, making sure you have a good understanding of what they are is an important step in the pre-approval process, and a visual aid should be involved. Now, take a look at the line item for interim interest. Eventually, you're going to write an offer for a home you want to buy, and you and the seller are going to negotiate a whole bunch of things, including your closing date. Until that point, your lender, really nobody, but your lender doesn't know when you're going to close. So they're going to have to make a guess and enter an estimated amount of interim interest. It is really common for lenders to estimate 15 days of interim interest, and I can kind of see the logic. The closing date's an unknown. You're going to wind up paying between 1 day and 30 or 31 days of interest at closing. So, hey, let's split the difference. It makes sense. But there's a problem with this line of reasoning. You'll pay exactly 15 days of interest or less if you close in the second half of the month. But what if you close in the first half of the month? There's a 50% chance your lender has underestimated one of the larger unknown variables in your closing costs, and I don't like those odds. Now, occasionally, a client will send me a loan summary from another lender with just a few days of interim interest, or even just 1 day of interim interest. Unless you told that lender you plan to close on the last day of the month, this is somewhat of a red flag. This lender is intentionally manipulating things to make the bottom line look lower in a way that is quite likely to change for the worse. The only reason to do this, to put just a day of interest, is to look favorable in a cursory side-by-side comparison with another lender's loan summary. In our example, the interest was a $2,000 variable, over a $2,000 variable in your bottom line. So if you don't understand how interim interest works, you may get the impression that the lender quoting $2,000 less at closing is offering you a better deal, when in reality, they're simply underestimating a fee that has nothing to do with the services they're providing to you and is almost certain to be higher in the end. And if you're refinancing, you are going to be paying a month of interest at closing. Absolutely, for sure. The only question is how that interest is going to be divvied up between the days you pay on your old loan and the days you pay on your new loan. Now, at the very least, if you receive a loan quote showing just a few days of interest, make a mental adjustment to account for the high odds that you're going to be paying more interest at closing. but it also might be worth talking with another lender. The care a lender puts into making accurate estimates and helping you understand costs as you get pre-approved is a good indication of how things are likely to go as you progress through your home buying and mortgage process. Until I know a closing date, I always include 30 or 31 days of interest on loan summaries for my clients. When I don't know something, when I know I don't know something, I try to err to the safe side. Nobody is ever unhappy when the final costs settle out to be just a little bit lower than what we originally estimated. So if you're looking for a lender who will be straightforward and educational and a partner in your home buying and mortgage process, I'd be thrilled to chat. My contact information is in the caption below. And thanks so much for watching.